Environmental accounting aims to preserve environmental capital, just as traditional accounting allows for financial assets to value companies whose actions are most favorable to the environment. The main objective of environmental accounting is to help companies integrate ecological issues into their financial decisions. Instead of focusing solely on profits and losses, the aim is to broaden the analysis to include costs associated with environmental impacts, such as pollution. This will be, for example, evaluating the costs related to environmental cleanup, fines for non-compliance, or even compensations for damages caused. Then it will be the depletion of natural resources. It will be the estimation of the economic value of consumed resources, like non-renewable raw materials, and the potential cost associated with their scarcity. Finally, the preservation of biodiversity. This will include the financial benefits associated with the protection of natural ecosystems that can provide essential services, such as pollination or climate regulation. There are several types of environmental accounting. First, physical accounting, which measures the flows of natural resources like water or energy. For example, how many liters of water are used each year? Then, there is monetary accounting, which translates environmental impacts into financial costs. How much does water cleanup or investment in greener technologies cost? And finally, economic and ecological accounting, which will integrate the costs and benefits of ecosystem services like climate regulation, bioforest. For example, why do companies adopt this approach? First reason, it will be related to regulatory compliance. With increasingly strict laws and regulations such as the CSRD, the Corporate Sustainability Reporting Directive of the European Union, companies are required to publish information about their sustainability. Environmental accounting helps provide the necessary data to meet legal requirements by enabling companies to measure, track, and report their ecological impacts in a structured way. Next, competitive advantages. Consumers and investors are increasingly prioritizing environmental issues. Ecological transparency and good management of environmental impacts can help improve a company's brand image. Finally, the third reason is risk management. Environmental accounting allows anticipating future costs related to environmental impacts. For example, by forecasting the costs of pollution, resource scarcity, or even climate change.